Hey, what's going on, guys? Today I want to make a quick video talking about swing trading and kind of like my strategy that I've been adapting and using the past couple months or so. Typically I'd like to sell covered calls on my long-term positions just to lower my cost basis, which is great. But another way that I've been doing is swing trading. I've actually been doing it on the Robinhood platform, but it's definitely applicable to all platforms out there: TD Ameritrade, Fidelity, whatever platform you're on. Um, and the whole idea is to just like to buy a bunch of shares. I mean, not even necessarily a bunch of shares, but how much ever you want to swing trade with. And then so say, for example, I wanted to, so currently I'm selling, all right, this is a bad example. Let's go to like McDonald's. Okay, so here I'm just selling five covered calls. And looking at the chart here, it has had a lot of movement today. So with this test account here, um, we have about $93,000 of available stock buying power. So this is obviously a paper trading account, like I mentioned before. But so to come into here, like my idea would be um, to, obviously try to time the market. This doesn't always work out the best, but even like a movement like buying in like right here, buying in on the dips. So you're looking at 235.34. And then, so say if you did end up selling out here, you made like a little bit over $1 per share that you bought. So say I'm not sure how much, let's see how much we could have bought with, what was it, $90,000? I mean, not even saying you have to use all your buying power. So let's maybe say like 25,000. So it's probably going to be, what, 50 shares? 50 shares would be like 12,000. Oh yeah, we still could probably do 100 shares. 100 shares would be right around 23,000. So yeah, so the idea with that one would be, like I'd mentioned, to buy it obviously on dips, but it would be like a day trade type of, or like a swing trade, couple days, couple weeks. But to buy it like right here, so you'd be buying at, say you got it in at 235, 235.50. So $23,550 it would cost you, and then you bought it in there, and then you wrote it up a little bit, and say you got out at 236.10. So you bought it there at 235.50, and then you sold it at 236.10. So you'd make a good 500 bucks there. So yeah, a little bit more than 500 bucks. But yeah, so then essentially once you sell that, you would then contact your broker and say, typically, do consult your own tax advisor. This is just my experience and not tax advice at all. But my understanding of the way that you can get in and out of positions are either using the FIFO method or using the Lifo method. So the FIFO method is first in, first out. So that is like what most brokers default to. So meaning in this scenario, it would whenever I would sell it like up here at the top, it would sell the first shares I bought. So say I bought shares, 3 years ago, that would be the shares that would get sold there. But if you told your broker to use the LIFO method, essentially it would sell the shares that you just purchased right here. So you'd be making the difference right here in short-term capital gains. So, do understand the risk, or not necessarily risk, but the implications of short-term versus long-term capital gains. But that's essentially the same idea with selling covered calls to a certain extent. But it's a little bit quicker. It can be a little bit riskier, so definitely do your own due diligence and um, do your own research with this type of strategy. But this is kind of what I've been doing for some of my long-term holds. So if it's a big dip, selling covered calls are great. I mean, typically that's a covered calls are like a bullish strategy though, because there's not a whole lot of downside protection per se with the covered calls. But this is another method that I've been using in hopes to, get that cost basis um, down to zero eventually. So I would have made $500 here on that one little swing trade in the matter of, I don't know, it was like 30 minutes or so. Not sure about the durations between. So it looks like at 2:30 to looks like it's only like 15 minutes. So, I mean, you could have waited even longer and made it bigger. But I mean, for anything like this, I'm just trying to get in and out as fast as I can, just take profits, um, just because I'm already long on the stock. I don't want to get stuck with more shares than um, I would need per se or would like to allocate for. But yeah, that's just I've been doing this last couple months and it's been doing pretty good. Um, Knock on wood. Uh, I haven't gotten caught yet with any big amount of shares yet, but yeah, definitely let me know what you guys think about swing trading on some of your long-term holds, just as another way to not necessarily leverage, but just another way to lower your cost basis for your shares. So as always, though, I'm not a financial advisor. Take this with a grain of salt and for educational purposes only. I just wanted to put this out there to get some feedback from you guys to see, you know, if anyone else is doing anything similar to this. Another, idea too, if you were to do this in your Roth IRA, all of those short-term capital gains wouldn't really affect you since it's already in a tax-deferred account. However, doing it like a regular brokerage account, you are going to get hit with that short-term capital gains. But yeah, once again, consult your own tax advisor. Don't take my advice as your only source. All right, guys, that's it for this video. I hope you guys got some value from it. Once again, let me know below what you guys think about it and if it's a strategy you might use in your long-term plan. All right, guys, thanks for watching.